morning, everyone. Thank you very much for coming to seize this particular moment this morning. The title of our panel is The New Economic Era, where geopolitics has taken center stage, globalization is in retreat, and inflation is sticky. How do you invest or run a company in this new environment? And how do companies fund themselves when the easy money is gone? On top of that, we have massive technological change. Workers are worried that AI is going to replace them. And investors and companies are trying to figure out how to use AI to make their operations more efficient or to make more money. Before we get into it, we do a little bit of audience participation. We have a poll. There's a QR code coming up somewhere. And please vote. Basically, the question is, and we don't give a time frame, we'll talk about that in a bit, what's going to have the biggest impact on the global economy? Is it structurally higher inflation? Is it industrial policy, also known as resource nationalism? Is it the fragmentation of supply chains or AI? So please vote. I assume you all have a mobile phone. And we'll get going, and while we collect the results, let's begin with geopolitics. We'll hear from Bloomberg's chief economist, Tom Orlik, later this morning what the economic impact of the current geopolitical challenges could be. Without front-running Tom completely, I'll just say we're talking potentially hundreds of billions, if not trillions of dollars in lost output. Jack, I'd like to start with you. You run a cross-border payment company, and you obviously see changes in money flows or a slowdown in cross-border trade firsthand. What do you observe?
I think over the last 2 years, we see some dramatic change in the global money flow, and it's kind of getting even worse from our perspective. In the last quarter, give you some sort of examples. We see supply chains have been shifting from China to countries like Mexico, Indonesia, Vietnam, quite significantly in the last 2 years. And we also see cross-border trade or e-commerce in particular get banned by some of the South Asia countries recently. So they start to encouraging local sellers selling locally online. And some of the largest cross-border e-commerce social platform has been banned by, for example, the Indonesian government recently, which is quite a disaster for some of the smaller businesses selling cross-border. So those geopolitical issues definitely played a very significant role in these changes in the last 2 years. And funny thing is, though, even we see the money flow have shifted, but we also see some of the shift of entrepreneurs. For example, we have seen massive amount of factories being setting up by Chinese entrepreneurs in Mexico. So we kind of joking internally that the entrepreneurs like animals instead of plants, so they would travel around the world to fulfill the demand of the new, global supply chain landscape to try to survive in this new era of global economy.
What does that mean for your company? Did you have to shift resources to different places?
We definitely see this trend, that shifting to Latin America and the Middle East and some of the South Asia countries. So recently we have done acquisition in Mexico of a payment company, so to strengthen our presence over there. As we see, as I said, the supply chain have shifted, the factory have moved, but the customer remain largely the same. And we also, getting our license in the Middle East, like UAE and Saudi, as well as sort of Brazil in Latin America. And those, investment is generally a multi-year investment and require a lot of pre-investment to set up the financial infrastructure over there, working with the central bank to get permission for the money flows going cross-border. Generally, the exotic currencies or countries have pretty stringent capital control requirement to automating that requirement to providing a seamless experience for our customer being top of the mind for the company, and which is the area that we are investing a lot of time and energy on.
Thank you. Sarah, you run an organization that helps people invest for the long term. Is there a long term with all these short-term shocks these days? And I don't mean Dickensian long term where we're all dead.
There is a long term, and there will be a long term. The question is how to stay focused on the long term with all the short-term noise. And so the way that I think about it a little bit is for countries, what the countries are doing is thinking much more deeply about their critical skills, critical materials, critical supply chains in a way that has not been done in the past. So from a country point of view, we're seeing a real shift to not just competing for this quarter, but planning for the future. From a company level, the strategy is really changing. The conversations in the boardrooms are much less around, okay, how are we going to gain a little market share here? How are we going to cut costs here? And how are we going to play offense in this sort of environment if there's an opportunity for us, depending on where we're coming from, and how are we going to play defense? How are we going to protect ourselves because the shifts are so large? And then I think for the investors, there's a real shift. We all know the traditional risk-return framework, and risk has traditionally been measured in terms of short-term volatility. What do the markets do at any particular point in time? We're seeing people really trying to shift to much more of a risk-return resilience framework, which is thinking about, of course, the return over time, but also the short-term risk and resilience to some of these long-term trends. And so questions about can we invest in a particular place, or would we perhaps have the keys taken off of us at the wrong time, are really driving investment conversations in a way that they were not just a few years ago.
Mark, you told my colleague Eric Schatzker the other day that, I quote, the world is facing a new paradigm with incalculable outcomes. You also mentioned how fast things are changing. Tell us about your 1,000-day analysis.
Well, look, I think in my 3 decades as a professional investor, this is by far the most difficult environment to operate in. Investors, by their nature, are trying to predict the future. You don't try and predict the future with obviously any certainty. You predict the future in terms of the probability of certain outcomes. Today, you can't calculate the probability of certain outcomes. The world has changed and it's moving so fast in ways that none of us have ever expected, but also importantly in ways that we can't measure. You can measure the sensitivity to your portfolio of a change in interest rates. You can measure the duration risk in your portfolio. You can measure how much the price of oil may impact your portfolio or the change in a currency rate. But the last 1,000 days, and it's only been 1,000 days. 1,000 days is not even the blink of an eye in human history. It's actually even not that long in a human lifetime. But the world has changed more and more unpredictably in the last 1,000 days than any time, in my view, since the Second World War. Let's think about it. 1,000 days ago, we were at the early innings of a global pandemic that we didn't really understand. 1,000 days ago, we were just starting to think about decoupling and the friction between China and the West. 1,000 days ago, no one thought there was going to be a war on the European continent. 1,000 days ago, the Middle East seemed to be headed in a very positive direction with the Abraham Accords, et cetera, taking hold. Today, all of those things have changed, and changed in a way that none of us could predict and none of us can measure. And so I think we are in a period of incredible uncertainty, not just in the world, but also in the way that we're going to deploy capital and the way that we are going to be able to fund the liabilities that we have for the long term. So I think investors have to think very differently how they go about doing their business. 1,000 days ago, I wouldn't have thought that having geopolitical experts on my investment staff was particularly important. Today, it may be all that matters as I try and make the calculus of risk and return and probabilities going forward. It's really hard, and I think we are in a completely new environment for anybody who's been in this business in their lifetime.
So, as a chairman of a pension fund, what do you do?
Well, first of all, I have a fantastic CIO who's here in the room, and I asked her to figure it all out on our behalf. No, look, I think what you have to do in terms of governing an organization, and those of us that have responsibility for the future financial stability of millions of people in the case of a pension fund, or the future financial stability of a country for those who are involved in a sovereign fund, or the future payments to clients for those who might be in the insurance industry, for example. And I think the responsibility today is to ensure that you are always thinking about those long-term liabilities, back to what Sarah said, but how do you reposition the way that you invest in your portfolio in a very different way to give people some certainty, in their lives in a world that is incredibly uncertain. If at least I can be sure that I'm going to have a pension when I retire, at least I can have some certainty that my insurance policy is going to pay out, or at least I can have some certainty that the funds are going to be there to improve my country, that can help. And so I think the responsibility on those of us that govern, or in the case of Marlene Puffer, our CIO, who work in this industry, I think the responsibility is even heavier on us today than it has been in the past, to make sure that we're trying the best we can to build a portfolio that's going to be sufficiently resilient with those incalculable odds in the long term, as Sarah says.
Scott, you're running one of the most successful credit hedge funds in the world. How do you take advantage of all the dislocations, maybe not long term, but short term?
Sure. I think, the teens were about, the last decade was a lot about private equity, shareholder returns, dividends, buybacks, corporate management teams doing well. Now you're in an environment of higher realized inflation, higher realized volatility, and higher yields. And that means that the pensioners and savers that were robbed the past decade can have that return to them. So we see investment-grade corporate bond yields, 5%, 6%, 7%, very attractive, be that corporate or structured or mortgage. I'm sure we're going to talk about liquid versus illiquid, but make sure if you're going illiquid, you're getting paid for it. I like self-liquidating illiquids right now. So what do I mean when I say self-liquidating illiquids? Reinsurance premiums, due to all the weather volatility we're talking about due to climate change, have doubled or tripled in cat reinsurance over the past year. A lot of the money that was in that market has come out of it. Those are 1.5 to 2 year investments you can make, and that money comes back to you pretty quickly. Banks, the regulation of banks over the past 15 years has done two major things from an investor perspective for alternative credit or yield product. It's created this huge private credit market, which now you can get 10 to 12% for first lien risk, better than equity returns with ERP, certainly in the US, very low. And now it's creating, as regulation comes more in globally with the Basel IV on the forefront, regulatory capital opportunities where banks are looking to divest assets to people like ourselves or others, and we can write them synthetic or cash derivative trades and take some of that capital off their balance sheets, 1, 2, 3 year investments against high quality revolver books, and get paid teens risk for very good, low underlying, good quality risk. And then finally, I think it's thinking about staying liquid, staying in that high quality credit. And when there are the dislocations, when there are those volatility spikes, the Silicon Valley banks, the Credit Suisses, the Israel war, you can then deploy into more interesting things. So allocating to people who can make that deployment decision for you quickly. And you can deploy long term, but you have to deploy during the dislocations, not at sort of the generic valuations we're at right now.
You feel good about your portfolio at the moment?
Sorry? Yeah, I feel very good about my portfolio. I feel better about the future opportunity set because I think realized vol is great for us. It creates multiple bites at the apple to deploy into. And if you think about where credit's going over the next 2 to 4 years, you're going to have an elongated default cycle that looks much more like what you've seen in the 1970s or early 2000s versus the central bank policies, a headwind now versus being a tailwind in a lot of the other cycles we've had the past 15 years.
Let's talk about resource nationalism or industrial policy. I mean, China has rare earths, the US has semiconductor know-how, Indonesia has nickel for batteries, for example. It seems like more and more we're seeing these crucial economies and technologies become the focus of economic statecraft as countries try to stay ahead in the global race. What does that mean for investors? Should they be piling into all these strategic opportunities or stay away because it's too political? Scott, maybe tell us about your experience.
I mean, real time right now, we're looking at a company in Panama. It's a Canadian company that was funded, a copper company, and there's been a populist movement to take away their mining contract. The equity's down by 60%, the debt's down by 30% in 2 weeks. There's a treaty between Panama and Canada that gives essentially $10 billion of capex back to the company if they take the asset away. You can buy the debt at a creative kind of $5 to $6 billion. So there are real-time opportunities being created by this economic nationalism. That's a specific one, but we see them pretty constantly. You know, Europe is essentially given over its industrial economy to the U.S. and to Asia and the Middle East, but due to a lack of stimulative fiscal policy there. And we'll see what happens with that, but there are certainly bifurcated opportunities to make bets on positive things that are happening in the U.S. through the IRA, or some of the countries in Asia that are experiencing an increase in trade with the West, whereas other parts of the world are leaving themselves behind.
Sarah, there's of course another type of resource nationalism, that's money. Sovereign wealth funds are increasingly the primary source of cash for pretty much anyone. Can you share your perspective, and in particular where it leaves the U.S.?
Yeah. So I think, as you all know, the U.S. doesn't have a sovereign wealth fund. We have a balance sheet. We have a reserve currency. We have all sorts of other interesting things, but we don't have a sovereign wealth fund. And in fact, if you look at the 10 largest funds in the world, asset owners, so pension plans, sovereign wealth funds, et cetera, how many of them are American? This is a trivia question. The answer is one. And it's probably one you may never have heard of, which is called the Federal Thrift Savings Program, which is essentially a bunch of computers in Virginia. So it is. So if you think about the resources that the United States has, we have, again, a lot of other resources. We have an ability to do the IRA. We have all sorts of other things. But we don't have that. And so I think an important thing to think about increasingly is, where is the capital and how is that capital going to be deployed, less in this sort of, you know, old-fashioned risk-return mindset and more in this geopolitical mindset. So large funds that are based in the Gulf, for example, are thinking more about investing in their own economies, or many funds are thinking about they can invest in this country but not that country. And so I think that what we're seeing is the use of large funds as a tool, which has not historically been the case. They've actually tried very hard to stay out of politics and to be neutral money. And so we're seeing that shift right now.
Mark, give us a view from Canada. You have a lot of money.
Well, look, I think a couple of points that Sarah made are very important. You know, first of all, I think we have to understand that, so I'll make 2 points. The first is, I think we have to understand that it may very well be that the Ricardian idea of comparative advantage and Pareto optimality in the world is gone. That no one really cares about efficiency anymore. Policy is less important than politics. And that has a cost to it. Those of us who believe in the benefits of globalization are really seeing those benefits unspool. And don't underestimate the continued cost that has to the global economy, and the added inflationary pressure that causes, both because of the cost of building resiliency into supply chain and other systems, but also the cost of this sort of economic nationalism from incentives that are created, like the IRA, all of which is inflationary in nature. So the first thing is, don't underestimate, as we unspool the benefits of, rightly or wrongly, of globalization, how much continued pressure that is going to have, in particular on national balance sheets, and what that is going to mean in terms of capital flows, interest rates, and so on. So I think we're still underestimating the global impact, and again, back to how everything has changed on the macroeconomic system. And I think there's more to come, and the disequilibrium in the system is going to continue to have very much unintended consequences. Great if you can figure it out running a hedge fund. I'll tell you, it's a hell of a lot harder for my brain to calculate. Secondly, industrial policy matters. And so to come back to Canada for a minute, countries need to have an industrial policy. They need to compete. If it's no longer about sort of comparative advantage and you have to compete everywhere because you're bringing more parts of your economy in-house, how is it that you're going to compete? How are you going to create industrial policy as a nation or as a state in order to win in this complex environment? And I look at my country of Canada. We are endowed with some incredible advantages, but I would posit that we have not had an industrial policy as a country in terms of, it takes very different thinking than we've had in the past, in terms of how we are going to compete hard in the world and win, and also at home. Canada's running a productivity deficit of 27% to the United States. That is not a sustainable position anymore. We can't rely on low-cost production in other parts of the world, and we don't have sufficient fiscal resources in the country to continue to benefit on the social programs that we've come to enjoy unless we can compete in the world. So what I would say is countries have to have today a robust industrial and national strategy of how they're going to compete. And if they don't do that, it's at their peril because, again, you can't rely on sort of globalization to get you to a point where there's some form of Pareto optimality and you just benefit from your comparative advantages, be it low-cost labor, be it because you have commodities, et cetera, just because you have them. So if you don't have a clear, cogent, and well-executed economic strategy, you're simply going to be left behind. I would say Canada is a great exhibit in that. There's several countries in Europe that I would point to that are also great exhibits in that argument. Meanwhile, I think our lunch is going to get eaten by places that do have that, like India.
I was just going to ask, who do you think is doing the best job in terms of industrial policy?
Well, look, I think if you look at the countries that, obviously we're sitting in Singapore, so, here's a pretty good example. And people can always make excuses and say, well, Singapore's easy, it's a city-state. But policy in this case matters, but what matters almost as much as policy is the execution of that policy. So yes, it's easier to do in Singapore than it is in India, but I think if you look at what's taking place in India, there's a clear policy of where the country wants to go. That policy is integrated across the value chain, both politics and business, and it's making a difference. Is it sustainable? We'll see. But there's a strategy and there's execution. And so I would say that countries that have a clear, cogent industrial strategy and the execution to back that up are the ones that are going to win in this new paradigm. And if you rest on your laurels and you say that we're going to win because we have iron ore, or we're going to win because we have oil, or we're going to win because we have low-cost labor, or we're going to win because we've got an advantage in semiconductor manufacturing, or whatever it is, if you just make that assumption, you're not going to win. Not anymore. It's all changed.
I'd like to zoom out a little and talk about companies and funding models that are changing in this higher for longer interest rate environment. Jack and Scott, you're both company founders from a slightly earlier era. What advice do you have for the founders of the current generation? How do you get money? Jack?
I think the funding environment in the last 2 years is definitely the worst I've seen since I founded the company in 2015. Especially when it comes to building, I guess, infrastructure businesses that require a lot of upfront investment before you're able to generate real revenue. I think, I've been debating with a lot of investors, and we feel the boat have sailed a little bit, that is very few investors out there are willing to take the risk to investing hundreds of millions of dollars for a pre-revenue company. So it's going to be a challenge, apart from you and AI, which is a different story. I think, we in fintech, and fintech went from the darling of all investors around the world in 2021 to probably the worst performing sector in both the private and public markets. From an entrepreneur perspective, we see, that we need to really looking for investors from all regions. You can see a lot of investors being traveled to the Middle East. You can see a lot of entrepreneurs being traveled to the Middle East quite frequently to looking for capital, especially there's a lack of appetite for, I guess, U.S. or European investor in investing in China-related business. So it's definitely a sort of trend for more kind of close relationship between the Middle East and the Chinese entrepreneurs. And even for the U.S. and European investors and entrepreneurs, that we see also a lot of challenges, especially in the growth stage and late stage companies. The valuation have been compressed not by 10-20%, but 80-90%. And I think all the lucky thing is most of the late stage companies that have been doing well in 2020, 2021 have raised a lot of capital, and they have more than 5 years of run rate, and they just need to growing back to the valuation they were at a couple of years ago. Also, it's quite interesting for companies operating in a high interest rate environment. For example, Airwallex is cross-border payments and global banking business that, we have a few $1 billion of flows sitting on our balance sheet that kind of right now yield hundreds of millions of revenue, which is not the case a couple of years ago. How are we able to utilizing those capital to reinvest in the business? And how do we actually keep it sustainable for the long term for the company, which is another challenge. And we also, see the opportunity in the broader business, ecosystem. How can we launching product to sort of benefiting businesses operating globally, leveraging this high interest environment? For example, recently we launched a product called Yield, essentially allow businesses globally to invest in multi-currency, high interest rate sort of return product that by partner with JP Morgan. For example, businesses in Australia, a startup that raised capital in US dollar, traditionally they have to convert that back to Aussie dollar to earn interest. Now we allow you to invest in many currencies. In this case, we'll allow you to invest in US dollar to yield more than 5% on the capital you raise. You don't have to convert it back to Aussie dollar straight away. I think this is just different ways for businesses to leveraging the sort of environment that have changed quite significantly in the last 2 years.
You feel good about your own funding?
Well, from our own perspective, we fall into one of the lucky companies that raise a lot of capital. We raised about $1 billion in our history, but half of that is raised in 2021. And we have the companies is lucky that now profitable, and we still have more than $500 million in the balance sheet, and they're still growing at 100%, and benefiting from we call reglobalization, which is what we just talked about. And I think that's give us the opportunity to even investing more aggressively in this environment. That said, I think a lot of companies struggle to get funding, in the last few years, and especially for infrastructure company. How do we actually balancing the profitability and the growth is kind of a very interesting topic, and we're in a very lucky place to continue able to grow, but with the sort of positive cash flow.
So when are you going to go public?
We'll figure something out when the equity market's back to the normalized level.
Okay, Scott.
Yeah, I'll be quick. So when we were raising the money for our first fund in 2017, and we were on the road marketing, we had a joke that seemed funny at the time was, the world needs another hedge fund about as much as it needs a global pandemic. And my partner John repeated it in all the meetings. It obviously wasn't very funny come 2020, and now we're doing private credit, so we've had to redo the joke. But I think Jack hit the nail on the head. You want to, whatever business you're in fintech, you're in AI, you're in credit, you're in asset management, your asset and liability structure has to match. Right now, you're in a higher realized volatility environment, and whether you're a private investor, public investor, corporate company, if you're worried about your funding, it's going to massively distract you from what you're trying to do as a business. So you cannot have that be your number one concern. You need to solve for it and have someone that monitors it for you. But if that's what you're worried about every day, you're not going to be worried about running your business. So that's I'd say a really big thing that I would focus on. And then as you bring it back to what we did when we started, having people around us that could give us leverage. So as a founder, you kind of either move up and you delegate, or you stay doing and you build around. And we've stayed doing the job and built around ourselves. I think there are two models and they both can be successful.
We have the results from our poll, which have been up for a while. We were joking earlier that in the long term, AI will win, but it looks like geopolitics is number one. But we'll talk about AI.
They changed the questions, actually. They added geopolitics from from the four that we had before.
So anyway, geopolitics wins for now. But long term, obviously, AI is huge. Everyone's talking about it, especially since ChatGPT burst into the public eye a year ago. Jack, let's start with you. You have a company. Is it all going to be AI, or is it already AI?
I think I asked the question I've luckily had a chance to ask the question to Sergey Brin, Eric Schmidt, ex-Google, and also Bezos, Amazon. I was like, how big is AI? And all the answer is AI is bigger than the internet. It took me a while to digest. Remember, I had dinner with Eric Schmidt about sort of F1 in Singapore last year. And he said, there's some real breakthroughs in large language models in the last few months, and you're going to see some dramatic changes in AI. And I'm kind of skeptical at the time, but then ChatGPT came out a few months after that, and then just become a global phenomenon. And I think spending now kind of close to a year or over a year that digesting what it means for businesses around the world. I'm spending a lot of time with the folks at OpenAI, Stability AI, and just various sort of entrepreneurs around the world in this industry. One kind of conclusion, or a few points I wanted to point out. Number one, sort of productivity going to significantly increase. If you think about, what's the biggest technology shift in the last 15 years is the cloud. The AI is only going to be bigger than the cloud. It become a fundamental infrastructure that injecting in consumers and in businesses' sort of everyday behavior. How businesses or any people sitting here that are able to leveraging that innovation into their own process or workflows and data going to be significant. I think there's going to be a lot of interesting companies benefit from this technology shift, just like the cloud. Some of the largest businesses, thousands of billion-dollar software companies have born out of the cloud, and I think AI only gonna be bigger. I think a lot of the consumer behavior going to be fundamentally changed in the next decade because of AI. Is the second point I want to make. How can we leveraging this technology to innovate in this space? It's a very interesting topic. I mean, last point is like for B2B company like Airwallex or a payments company, we have a ton of data. And we're also servicing over 100,000 businesses around the world, competing with the traditional banks. How can we leveraging AI in servicing our businesses better? So we basically developing we call co-pilot strategy that in every single team within Airwallex, we actually will have a co-pilot, essentially the AI infrastructure or agent to help our employees to gain productivity on the job every day. And we're also building a lot of AI-empowered tools for our customer. How can we helping our customers' employee managing the expenses, managing the reimbursement, to submit or to fulfill the company policies, to increasing productivity. And then even think about long term, most of our employees in a sort of CFO office or in a G&A function spending time to doing ad hoc work. And this ad hoc work is very time consuming and now can be significantly the efficiency can be significantly increased because of AI. And we're also kind of thinking about the ERP landscape going to be fundamentally changed because of AI, instead of a workflow system, but will change to a more data-driven sort of AI approach in the next decade.
Sarah, the long-term perspective on AI?
Yeah. So, we're the long-term people. We really think a lot about these long-term trends. We've talked a lot about, our shorthand is the 5 Ds of disruption. So we've talked a lot about deglobalization today. We've talked some about demographics over the last day or two. We think decarbonization is one of those long-term trends, which we shouldn't forget, deleveraging with higher rates, and then digitization to make our Ds work, or AI and generative AI in particular. And I think this, I would agree with Jack, this is really going to be a fundamental change. And the way that I think about what generative AI is doing is it's really taken your computer from being a tool to being your teammate. And I think what frustrates people about generative AI is the same thing that frustrates you about your teammates, which is they might be wrong, they might be biased, they might have an idea that you didn't think of. But that's what's so powerful about it. It is a brainstorming machine, not a calculating machine. And I think if we get our minds into that, the possibilities are really enormous. So I'll just give you one simple example of something I do in philanthropic side of my life, which is work with a biological institute that's related to MIT. They're trying to figure out, they were the ones who sequenced the genome, haven't figured it out yet. It's going to take a lot of time and a lot of money. But how do you build a virtual cell with AI? If you do that and you can experiment on it, then just think about the possibilities that are unlocked that are way beyond making our businesses a little bit more efficient. So I think this is the next big thing. I don't think we know what it's going to do, but I think we need to think of it as a teammate, as a brainstorm machine, not as an answer machine, and that will help us.
Mark?
So look, the only thing I would say about generative AI, I think it will change the world, but it's going to change the world. It's going to take longer for it to change the world than any of us think. Every time there's a new technology, especially those that are around it, believe that adoption is going to be unbelievably quick. And it turns out that adoption is actually really, really slow until it isn't. And then adoption takes off. And this will follow inevitably the same pattern. Those that are very close to it believe it's going to change everything tomorrow. But in the reality is, adoption takes a very long time. Use cases and the best use cases aren't necessarily the ones that we imagined early on. Eventually, you hit a tipping point in adoption, and the adoption ends up being much more rapid than people anticipate. Let's just look about autonomous vehicles. Let's just take that as a simple example. If we were sitting here 5 years ago at some sort of forum like this, we would have talked about how fast autonomous vehicles were going to change the world. You've heard the discussion. Remember, the big #1 job in the United States for middle-aged white males? Truck driver, right? By 2024, they're all going to be out of business. What's that going to mean to the world? There's not going to be a single truck driver left in the United States. They're all going to vote for Donald Trump, and we're all in big trouble. Now, it may be that they all voted for Donald Trump, but there's not a single autonomous truck yet on the road operating in the United States. Will there be? Yes, but it's going to take a lot longer, and when the adoption does start, it will be actually a lot quicker than we thought. As it relates to generative AI, we're going to be in the same boat as we've been in other technologies. It will change the world. It'll change the world in ways that we don't necessarily anticipate, and it'll take longer for it to take place. So I think the amount of excitement over it is well-founded. But I mean, check yourself, in my view, before you load up on another few thousand shares of NVIDIA.
I actually respectfully disagree on that point. I think generative AI going to change faster than anyone will imagine in the next few years.
And that's what makes a market.
Yeah. Scott, your perspective?
Yeah, I think that, is it Google and it's an accelerant for everyone? Is it the internet, or is it Amazon, where it's capital destructive for all the competitors? And I think first it's Google. It's going to be an accelerant and make everyone better, and then it's Amazon. And my investors aren't paying me to find the next. Let's assume that Google, Meta, NVIDIA, the winners are known to some extent. The easier money for us to make around this theme is going to be shorting the losers the next 5 to 10 years.
What are the losers?
Well, I
10
think
seconds.
call centers, clerical legal jobs, anything that involves paper pushing that can be easily digitized are obvious losers. And when we think about shorting credit, the equity put and the credit put are usually at very different strikes. Technological change brings them to the same strike, which gets really interesting. In terms of our team, we're using it, but the problem is it's based on backward-looking information. It's all based on historical data, and it tends to lie. So we had our analyst, who's our retail analyst, looking. He asked it. I think Cole said we're having higher defaults on our credit card portfolios. He said, look back 30 years is a sign of defaults on corporate earnings calls in credit card portfolios. What does that mean for consumer behavior the next 6 months? And it made up 10 quotes. Bard did. So you can't necessarily trust the output yet, which is a bit of an issue. So I think it's a helpful tool, but in terms of our investment team, we need humans to make the decisions because it doesn't tell you the truth all the time.
I'm going with the replacement of panel moderators as your...
Next year, there will be an avatar of me here. So. Sadly, we're out of time. That was fun. Thank you so much. Thank you for listening.